I want you to imagine this. There's a man, his name is Robert. He worked for 35 years, he's retired, he's done everything right. Saved his bonuses, invested a certain amount of his money, and now he's ready to go into the next chapter, which will be the best chapter of his life. And yet, the day that he retired, he discovered something that no one had warned him about, that he inherited a new business partner, Uncle Sam. Uncle Sam said, every time that you get paid from your 401k or IRA, I get paid from your 401k or IRA. He says, every time that you take some different money out, that bam, I'm going to increase your Medicare premiums based off of the income stream. He said that you were playing the game by the rules. You wanted to experience life and do all these amazing things. Boom, you're in a higher tax bracket, and he's taking more of your hard-earned money out again. But the thing is, it didn't have to be this way for Robert. He had options. He just didn't know. No one told him what they were. If that is something that bothers you as much as it bothers me, then this video is for you. Because I'm about to show you how to legally, ethically, and confidently lower your taxes in retirement. And we'll go through 7 strategies. I mean, there's a ton of them, but we don't want to overwhelm you. So let's just go through 7 of them. Number 1 on our list is using your Roth accounts wisely. So when we're talking about using the Roth accounts wisely, the first thing we should probably mention is that you should actually have some tax-free investment accounts. Most of the time, people are thinking, I have my pre-tax accounts, which is money that gets deducted today, and then I pay taxes in the retirement. And then you have your tax accounts, which is money that gets taxed today, and then it does get taxed at a much more favorable tax rate in retirement, as capital gains is normally going to be what it is if it's invested for a year and a day. But you have the third option, which is your Roth accounts. If you're someone who wants tax-free money in retirement, and I don't know why you wouldn't want tax-free money in retirement, then you would be considering something that we would call a Roth ladder. And all a Roth ladder basically is I'm saying that I have money inside of my IRA and my 401k that is going to be taxed as ordinary income in retirement. If I'm able to start early enough, I can then take out small amounts of that money every single year. The idea is that I'm hopefully going to pay a lower amount in taxes today than I would in my retirement. If it's somewhere where you're like, you know what, I actually think I'd have a lower tax rate in retirement, then there's no reason to even consider this. The goal is for you to keep more of your hard-earned money. But if you are someone who feels that it is at least a possibility that you might have higher taxes in retirement, then doing these Roth conversions early is a great strategy. Where if you have $1 million in your pre-tax account and you don't want to be taxed to ordinary income on millions of dollars, then you could convert $50,000, $100,000. You can convert a certain amount every single year, ideally in a lower tax bracket, and then you're able to have tax-free money in retirement. You have no restrictions on when you have to access the money. You don't really have to overthink it. You've already gotten rid of Uncle Sam. If we're sticking with our business partner analogy, it would be like you paid your business partner off. You're like, let me go ahead and get rid of you now so that my money can keep growing, but now tax-free. Versus if we start in this business together and we have $1 million in the account, well, in 5 years and 10 years, there may be 1.5, there may be $2 million in the account, which is all going to be a part of the growth that Uncle Sam is expecting you to pay him a portion of. Number 2 on our list is timing your Social Security. And there are different feelings on when is the right time to take Social Security. You guys know that because I'm so big on flexibility, I believe it actually can be different for each individual person. There's literally hundreds of strategies that we can implement for someone to optimize their Social Security. And I'll put a link to a video where I go through a couple of those. But the main thing that we're going to focus on here from a tax perspective is if I know a portion of my Social Security could be taxed based on how much income I have in retirement, then if I delay my Social Security, it's possible that I'm able to lower some of those other income streams early on, and I offset that with the growth of having Social Security that's continuing to increase as I keep waiting. The idea is if I retired at 60 or 62 and I started Social Security right away, that is one income stream that I just turned on and it never turns off ever again. That you're not able to call them up and be like, hey, Social Security, I'm about to be moved into a higher tax bracket. Can you please not give me my check this month? They're going to mail the check anyways. And for some of you, if you have rental income or you have other investments in a business where it's kind of hard to shuffle the money around where that income is going to keep coming in, then it becomes a question of, okay, if I turn on Social Security now and it's stacked on top of my rental income and it's stacked on top of my business profits, what is that going to do from a tax perspective? And so sometimes what people will do is they'll say, well, I have some of my money that's sitting in an investment account. And if I just focus on that pre-tax account, i.e. I don't want to wait for my required minimum distributions and Uncle Sam's going to harass me. I just want all my income streams to be the most tax efficient income streams possible. Well, you might say, all right, well, let me start with my pre-tax account, take the money out of my 401k in my early retirement years. I'm going to spend the same amount of money. We're just choosing which accounts we take the money out of. And so you say, all right, well, I'll do that each year. And then your pre-tax account, your 401ks, well, now that possibly is completely gone. But then you're able to still use the other income streams and then turn on your Social Security at 70. Now my Social Security is about 130% higher than what it would have been. And I don't have the other income streams where when you add them together, it moves me to a higher tax bracket. So that way I'm able to kind of maintain my lifestyle, but I paid a lower taxable amount because I was able to take my Social Security at a particular point in time where it wasn't going to be stacking on my other income streams. And so there are a couple of approaches, but it depends largely on life expectancy, the income streams that you have as far as those bridge years. That's normally what we mean when we say, I could start Social Security at 62, but I'm okay waiting to turn that on. We normally have to bridge those years from 62 to 67 if we waited for your full retirement age, or 62 to 70 if we waited for the maximum age. Either way, we have to have some sort of income to fund you. And if you're still working, that's great. Obviously, if we're still working, that's something that we could consider. And now we don't need the Social Security, but then we're also not taking the money out of the other income streams, which kind of leads you back to the first one where a Roth conversion might be the approach to use there, because the idea is to have everything set up in a way where I get to keep more of my money in retirement and Uncle Sam gets less of my money in retirement. Number 3 on the list is managing your required minimum distributions. So you have a handful of approaches that you could think about, but your required minimum distributions means that you have certain income that has not been taxed yet. And because it hasn't been taxed, Uncle Sam is tired of waiting. And because he's tired of waiting, he has passed laws that requires you to access that money at the age of 73. And if you don't access that money, then you will pay a 25% penalty on the amount that you should have taken out. And so when you're thinking about this, and of course there's exceptions, like if I work at certain places and I haven't retired yet, but once we retire and we're at a certain age, we have to start taking the money out if it's in an account that has not been taxed yet. And that's really what the main difference is. If it hasn't been taxed, Uncle Sam hasn't received any money. He gave you a tax deduction early on and he's tired of waiting. And so he's like, I need to get some tax revenue. Don't you see I'm out here with almost $50 trillion in debt? I got to get some of that money. Now, you and I can have the conversation on, well, I think we probably could cut on some of the spending, but we're just talking about the way things are currently. And the way things are currently, required minimum distributions is a real thing that we need to consider. And I'll put a link down in the show notes where you can see a required minimum distribution calculator, and you can put in the money that you have now, and then it can show what the growth is expected to be and how much you would expect to take out later once you're of age to have required minimum distributions. And the reason I like that is because a lot of the time when we're thinking of required minimum distributions, we don't count the growth. And what I mean is that we're sitting there and we're like, hey, I got $500,000 in my account, so I'm putting in the required minimum distribution calculator. That means that I'll have to take out $30,000 when I retire. Well, there's two things about that that are a little bit too simple. Number one is your account won't actually have $500,000 when you retire because your account is going to grow or lose money, but it's not going to be the exact same amount. And if you just assume a conservative return of 3 to 5%, then you still would be planning to have at least about $700,000 in that account. And then that would change the amount that you'll be expected to take out. And the more money that you have, naturally, the higher that dollar amount is in your account, even if the percentage is the same, right? Like 4% of $10,000 is what is that? It's like $400. And then 4% of $100,000 is $4,000. 100% of $1 million is $40,000. 4% of $2 million is $400,000. So you can see that depending on the amount of money that's in the account, it changes what that amount ends up being in the account. And as that amount changes, it changes how much you're required to take out. And for many people, once we're 73, we may have a whole bunch of things that we're still doing where we need to fund it, and it's not a big deal. But for some people, I find that they're kind of chilling. They're volunteering at the local library. They're sitting on the back porch reading a book. They're part of certain clubs and networking groups, but they don't do as much of the traveling and the expensive and the lavish things. And to have Uncle Sam require you to take the money out, that can be just kind of annoying if you really think of it. So the idea is a couple things. One is, as we mentioned, you just do the Roth conversions. If you have paid taxes on the money, Uncle Sam is a little bit nicer. No required minimum distribution. There are others where you might say, well, how about I just donate the money? And that's a great approach. The difference is if you take the money out of the account, put it in your hand, and then give it to the nonprofit or the charity or whatever, well, now it's counted as income for you because the money was in your hands and then you chose who to give it to. Versus if you do something called a QCD, a qualified charitable distribution, where I pay the money directly to the hospital, I pay the money directly to a nonprofit, it now gets to count as your required minimum distribution, but it doesn't count as taxable income because the money didn't come into your hands, but you don't have to take any more out. So you don't pay taxes, the charity doesn't pay taxes, and you're still able to give the money that you had always planned to, right? So if you donate money to your church or your synagogue or your mosque, and you do that every single week, it may require just a little bit of planning ahead of time, but you could set it up where the money just goes directly to that institution, and then you don't have the taxable income, they have the money to continue the mission, and rainbows and Skittles. Everybody's happy. I tend to find that if we're kind of late to the game, where we are kind of past the point of being able to do those Roth conversions, then it's kind of setting up the pieces of us identifying different charities that we would like to support, different institutions that we will want to promote, different beliefs and causes that we'd want to further, that we're able to then donate in a way that still allows us to have the most tax efficient approach where my taxable income is lowered, but I'm still giving to the mission. And that's just kind of a win-win if you really think about it. Number 4 on our list is understanding which bucket you want to withdraw your money from. So we normally talk about it from an investment perspective, where I have my safe, my moderate, and my aggressive investments. But from a tax perspective, you have your taxable income. And so that's normally going to be your brokerage accounts. That's the money that you invest in like Robinhood or any of the other investment accounts that you take your money from your bank account and you then go and invest it. That could be a business, that could be real estate. That is your taxable income. That money was taxed when you got it, and then that money is taxed when it grows. And it's normally going to be taxed at capital gains, which is a much more favorable tax rate than your normal ordinary income taxes. Second is we normally would have a tax deferred bucket. Our tax deferred bucket is just how it sounds. The taxes were deferred. So that would be your 401k, your 403b, your IRAs, and some annuities, just these type of accounts where I didn't pay taxes on it today. I actually had a tax deduction today, but it's going to be taxed as ordinary income in retirement or whenever I take the money out. And then your third bucket is your tax-free bucket. And then we can laugh and enjoy and sun and fun in the shade thinking about our tax-free bucket. Ha ha, Uncle Sam, as I go in and take my money out and I know that there's no taxes on it. It just makes me smile even thinking about it. So your tax-free bucket, that's going to be the one that we normally want to grow the longest. Normally, everybody's a little different. It can vary depending on where the money is at, how your money is allocated in those taxable accounts. But if you have money in a tax-free bucket, we normally wait for that last because the idea is, well, let me go ahead and get rid of my tax deductible accounts because that's going to be taxed as ordinary income. So I want to make sure that whenever I have a lower taxable income year, I'm going to go into that bucket first because I don't want to have required minimum distributions and I don't want to have something that moves me into a higher tax bracket. We then normally will move into our taxed bucket. And so your tax bucket, as we mentioned, is going to be everything that you invested with your taxable income. That's your regular investment accounts. That's your business. That's your real estate. This is all the money that is normally going to be taxed at capital gains or at least a much more favorable tax rate than ordinary income. A lot more tax deduction in these things. And it's normally going to be something that we're very beneficial, right? I'm happy I'm not paying ordinary taxes. It's not awesome as paying no taxes, but it is a nice, happy middle ground. I think most of us recognize that from a tax incentive society that the United States is, that the two goals Uncle Sam has, and he has a bunch of goals, but the number 1 and number 2 is for people to have a job and for people to have a house to live in. Uncle Sam doesn't want nobody under a bridge, and Uncle Sam wants a tax base of people that is paying the highest percentage of taxes. And whether we think that it should be that way or shouldn't be that way, the goal as your certified financial planner is to tell you that this is how it is, and it is in our best interest to have our money in places that Uncle Sam incentivizes us to keep it. And so right now, if you have your money in real estate or a business, Uncle Sam is super excited. You're giving people jobs, you're giving people a roof over their head. And so then that's normally going to be the middle bucket. And then once that's gone, our most favorable tax rate, we then move on to our tax-free bucket, and then it's just fun in the sun, rainbows and Skittles. Now, as I mentioned, that doesn't mean that that is always the best approach. It does mean that that works in a lot of scenarios. There are some where we do the opposite, where we do the tax-free bucket first because it's like, hey, there's not necessarily enough in there to fund my whole retirement, and it's kind of, it's kind of hit and miss. It's not really a big priority for my current retirement plan. So you take the tax-free bucket first, then you take the taxable account second. Again, it's sort of in the middle, and I'm okay with that. And the idea is if I get rid of everything, by the time I turn 73 and have my required minimum distributions, that's okay. It's the only accounts that I have. So I was going to take out more than what you asked me anyways. Required minimum distributions mean absolutely nothing to me because I have to fund my lifestyle and I've already spent off all the other accounts. So there is no issue with Uncle Sam taxing me at ordinary income because I've already been building up to this. This is the only income I have, Social Security and then my 401k. And I'm okay with that because the way I'm going to be living my life, that worked out perfectly for me. And there are times that ends up working for people. It's not as common. The most common is the first one, but it is to remind you that it's about flexibility. It's not about saying, well, this is what Dre said, this is how I have to do it. It's about recognizing the idea, right? What was the wisdom behind it? What was the goal we were trying to achieve and the situation that made that the right approach, more than it is like, I should do this. This is how I have to take the money out. And if that is something that you're kind of like, sort of get it, it's a little bit much, I do have, and it's in the show notes where you can go to happyretire.com. And I have a retirement tax savings checklist. It's a simple, clear, step-by-step guide that walks you through how to pay less in taxes and keep more in your pocket. Inside, you'll find how to structure your withdrawals to lower your lifetime tax bill, the right time for Roth conversions, how to avoid Medicare surcharges and Social Security taxation, and how to pass on more to your family, not the government. This isn't guesswork, it's just wisdom. You can go to happyretire.com and download yours today. Number 5 on our list is we can move to a tax-friendly state. Hey, and why not? So there's a couple things that you'll look for when you're looking to find the most tax-friendly state. Number 1 is you're normally going to look at how do you tax Social Security? Do you tax it or no? The second one is you might just look to see if they have a state tax, yes or no. And other things you can look at property values and different taxes like that. But there are currently 9 states that you can live in where you won't have to pay income tax. And if you're looking at the 9 states without an income tax, it's Alaska, Florida, Nevada, New Hampshire, South Dakota, Texas, Tennessee, Washington, and Wyoming. If you're looking for the states that don't tax or tax a certain amount, I'll put the information up for you because that one's a little bit more tricky when you're talking about Social Security and how they tax it, because it's like, well, if you make this much, then we don't. If you make this much, then we do. And it's not as clear cut. So I will put some information up for you to be able to see that, recognizing that there is nuances, but high level, this would be Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. Now they have what's called phase outs, which means like, hey, if you make over a certain amount, then we're going to tax a certain amount. And then if you make over that amount, then we're actually going to tax all of it. So that's what I mean when we say phase out, like you phase out of that tax deduction and then you phase into it being taxed as normal ordinary income. But again, that one is a little bit more complicated. It wouldn't do it justice for me just to try to explain those nuances to you, because you would either fall asleep if you're not in that state, or you would be like, I'm not 100% sure, this is actually slightly more confusing than I thought. So high level, we know that those states that I just read give you at least the possibility of not having your Social Security taxed. And then in the other states, it probably falls on the federal rules where it's going to be taxed if you make over, and I think it's like $25,000 in a year, then up to half of it becomes eligible to be taxed. And as a joint filer, normally if you make over $34,000, then you'll find that about half of your Social Security will be taxed. And then if you make over $35,000 as a single person, then upwards to 85% can be taxed. And then if you make over $44,000 as a couple, then upwards of 85% of your Social Security will be eligible to be taxed. Not to say that your tax rate is 85%, but it's to say that 85% of the income now counts in your taxable income. Number 6 on our list is to track your MAGI. That's your modified adjusted gross income. That matters when it comes to your IRMAA. So IRMAA is your income related monthly adjustment amount, right? And not very creatively named, but it's the idea that our Medicare is tied to how much income we have. There are different ways to really think about it. And even if you think back to the Affordable Care Act, there was questions of not whether you could charge people a penalty for not having health care, if you remember that. And then the question was, is this a tax? Is it a penalty to make people do things? And there's certain laws about how you can penalize people. That is what we're currently dealing with, even right now with tariffs, where what is a tariff? Is it a penalty? Is it a tax? Because if it's a tax, then that's supposed to be a law passed by Congress, right? You sort of get the idea of why it matters. I'm going to just cut it straight with you. For me personally, if the government takes my money, it's a tax. That's how I see it. And so I see IRMAA as a tax. And whether you are $1 over or $100 over, If you move into a higher IRMAA bracket on your Medicare Part B, there is a monthly premium associated with it. And if you move into a higher bracket, then you have that penalty amount, that extra tax for the rest of your retirement life. And believe you me, you don't want to be $1 over and have $100 difference in your monthly premium every single month. And I believe the number is actually probably more like $75. But it's currently set where, as an individual, if you make more than $106,000 in that year, then they have a 2-year look back window. So you have to be very mindful of those 2 years leading up to Medicare enrollment, where if you are over $106,000, it moves you into a higher bracket. And it says that your premium in 2025 will go from $185 a month to $259 a month. That's the $74 increase. If you make more than $133,000 as an individual, they will double the payment. Where it was $185 from normal Medicare Part B, it would be $370 every single month for the rest of your retirement life. And that number, you can't move up, you can't move down. It is what it is. It's set. And so you can see why it's super important to be very mindful about how much income you have of the year that you enroll in Medicare and the 2-year look back period. Because if they use those numbers and those happen to be a higher year, where you were like, hey, we wanted to put on a new roof, so I had to take out extra money that year. Well, okay, be mindful, because if you move yourself into a higher bracket, could we have taken out that new roof 3 years earlier so that it's outside of that 2-year look back? Could we have put on the new roof the next year after I enroll so that it's outside of that 2-year look back? There's just a little bit of planning that we want to have ahead of time, because those premiums are taxes, in my very humble opinion. Now, if you're talking about it for a couple, this one is, and sometimes our tax code is kind of weird. This one is pretty straightforward. It's $106,000 for an individual. It's double that for a couple, so $212,000. And so you don't have to worry about that from that perspective. Number 7, and the final thing that we can do to make sure we keep more of our money in our pocket when it comes to taxes, is we can do what's called tax loss harvesting. This is a very advanced strategy, but the idea is the taxes put your income in different streams, and you can write off different things depending on what the income stream is. So if you have rental income, there are certain expenses you can write off as a renter that you couldn't write off as an ordinary income person. If you have business income, there's certain income that you can write off as a business owner that you could not write off as an employee. And when it comes to your investments, you have the ability to write off some of your investments where you have these losses, and you can write off some of those losses against your gains, right? In the very simplest form, that's what it is. And so you're able to, I believe the number is, you currently can write off up to $3,000 of your investment income as ordinary income. You can write off all of the losses if you have that much in earned income from your investments, which I probably should say capital gains income, so that way it's clear and it's not as confusing. So if you have your capital gains where I made $100,000 in capital gains, but I lost $20,000, well, you could write off that whole $20,000. If you only had $15,000 in capital gains and you had $20,000 that you lost from your investments, well, you could write off the $15,000, and then you could write off the $3,000 as far as your ordinary income, and then you could move forward into future loss years, the extra $2,000. You can move that forward a year. And so that's all tax loss harvesting is. It's just simply saying that there are certain income streams that I can write off certain expenses, and your investments are no different. The money that you have invested in the stock market, you can write that off against other investment gains. And then you can write off up to $3,000 every single year with ordinary income, and then move the rest forward. If you're able to be mindful with these approaches, you can see that there are approaches, and it just requires a little bit of wisdom in the beginning, so that way I can manage these times of uncertainty a little bit clearer, where I know the right move for me and my overall retirement strategy. If that is something that is of value to you, I've already mentioned that inside of the link in the show notes, I will share with you our tax strategy savings checklist. You're able to use any of these strategies. It goes over a handful of them, and it just brings to your forefront a lot of these options that are available if you're trying to make sure that you're tax smart with your retirement plan. If you're someone that's like, you know what, Dre, I just think I might want to go this with a little bit of help, we can call that kind of the secret number 8 strategy. Just talk to a tax professional, and then you can see what type of strategies you can put in place. Whether that ends up being a CPA, a certified financial planner, we can have those conversations where we can look at the plan and see what makes the most sense for you based on the income streams that you have. You put the plan in place 5 to 10 years ahead, Then you start checking off the boxes on the way to doing that. It reminds me, I was actually having a conversation with my oldest daughter, and I was like, you realize that your plan to go to college and get a job, that was like a 10-year plan. And she kind of looked at me like, what are you talking about? And I was like, well, at 15, you basically were like, I have to get certain grades in high school if I want to go to college, right? So that's literally 4 years of the 10-year plan. But you didn't want to go to college for the sake of it, right? And she was like, well, no, of course not. I was like, well, what did you want to do? She talked about being, like a profiler. If you ever seen the show Blacklist, she wants to be like Elizabeth Keene. And I'm like, all right, cool. Well, you have to go to a certain school. You have to have certain grades. You have to get certain scores on your test. And then when you go to that school, what are you doing? That's another 4 years. So that way you then have the opportunity to get the job. That's a 10-year plan, right? You're not going to wake up at 24 and just get the job at the FBI. You would have had to line things up along the way. And we put a lot of planning into place for a lot of things. I've seen people put a lot of timing into buying something on Amazon, right? I'm not shaming you. Buy something on Amazon, look at the reviews, go through it. But then we don't put any plans in place for our money. We don't put a plan in place to make sure that we get to keep more of the money that we work hard and earn, that the money goes towards causes I believe in. It goes to my family. It goes to my retirement lifestyle instead of going to Uncle Sam. I mean, Uncle Sam's got enough money. He doesn't need our help because we didn't put a plan in place to keep more of our money. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, I'm Joy Griggs with Obsidian Wisdom. Stay safe and enjoy life.